Welcome back to the Deep Dive. Today we're taking on a real giant in human capital management.
That's right. We're talking about Paychex.
And we're going to distill all those corporate reports and briefs you've been seeing into the essential insights. So let's start with just the sheer scale of this company.
It's immense. I mean, to put it in perspective, Paychex is the engine for payroll, HR, benefits for about 800,000 clients.
Wow.
Yeah, and that covers something like 2.5 million employees as of their last big report in May 2025. For small and mid-sized businesses, they're basically essential infrastructure.
Exactly. And that's our mission today. We're not just, reading off the quarterly numbers. We're unpacking their Q2 fiscal 2026 performance to really get at two huge strategic moves they're making at the same time.
Right. The first is the massive acquisition of Paycor.
And the second is this huge push, this accelerated deployment of some pretty sophisticated AI across their entire platform. So we're looking past the headlines to see how M&A and tech are really changing the game for workforce management.
Okay, so let's jump right in. Let's start with those headline financial figures. This is for the quarter that ended November 30, 2025. The top line, I mean, it just looks fantastic for a company of this size. Total revenue was $1,557.6 million. That's an 18% increase year over year.
It's a really robust pace. And when you look at the operational results, they definitely back that up.
So you're talking about the adjusted metrics?
Yeah, the adjusted numbers, which, they strip out some of those one-time costs.
Yeah.
Adjusted operating income climbed 21% to $649 million.
And earnings per share?
Adjusted diluted EPS grew a very healthy 11% to $1.26.
Okay, but this is the crucial point, isn't it? The gap. If you look at the raw gap figures, the generally accepted accounting principle.
Right, the official number. The diluted EPS actually declined by 4%. It came in at $1.10. That's a huge difference between the operational story and the legal accounting picture.
And that's the context you absolutely have to grasp here. Whenever you see adjusted metrics move so far from GAAP, it means something big and non-recurring is messing with the bottom line.
And that something is Paycor.
It's the cost of integrating Paycor. That strong adjusted growth, the 11%, tells you the core business running payroll, managing HR, is humming along just fine. That $77 million difference on the GAAP side is what they had to spend.
So we're talking amortization of intangibles, compensation, all that stuff.
All of it. So you should think of that $77 million less as an operational failure and more like a strategic investment fee.
An investment to get bigger and better.
Precisely. They paid the price to absorb Paycor's platform and talent, and the underlying business didn't miss a beat. That's the story they're telling.
Okay, that sets the stage perfectly. So they paid the cost. Now let's look at the return. Where did that 18% revenue growth actually come from?
Well, the lion's share, not surprisingly, is from their management solutions segment.
Their core payroll and compliance business.
Right. That part grew 21% to over $1.16 billion. And the Paycor deal, which closed back in April, was responsible for almost all of that. It contributed about 17 percentage points to that growth.
So that suggests it's not just about adding more clients to the pile. They must have strategically upgraded their client base with this deal.
That's the key takeaway from the source material. It's really three things. First, yes, the sheer number of new Paycor clients. Second, more of their existing clients are adopting HR solutions.
Maybe the third.
But the big one, the most important one, is that Paycor brought a more upmarket client base.
Meaning bigger businesses.
Bigger businesses, yeah. And that translates directly to higher revenue per client, better pricing, and, they can sell more products into that merged platform. It's a quality uplift.
Okay, so Paycor gives them richer engagement. Did that success carry over to their other big segments, like PEO and insurance?
The PEO, that's Professional Employer Organization and Insurance segment, it showed really solid, consistent growth. It was up 6% to about $337 million.
And for anyone who doesn't know, the PEO model is where Paychex sort of acts as a co-employer, right?
Exactly. They take on a lot of the administrative and liability burdens, and the growth there was just driven by more businesses choosing to outsource that work and a rise in their insurance revenues. It's their steady, reliable engine.
And then we get to my favorite part of the HCM business model, the part that's just so fascinating.
Of the float.
The money they make on the float. Interest on funds held for clients saw this. this dramatic 51% increase. It jumped to $54.3 million.
It's an extraordinary surge, isn't it? This
Yeah.
is the interest they earn on client money they hold for just a few days before sending it off for taxes or payroll.
And it's pure profit, basically.
Very high margin. And that 51% jump came from two things. First, just higher investment balances. Again, the sheer volume of cash from Paycor's clients gave them an instant boost.
So they didn't just get new clients. They got a whole new pool of capital to invest.
A huge new pool. And the second factor is strategic. They reported higher realized gains because they've been repositioning their investment portfolio to take advantage of the rate environment. They are actively managing that float to squeeze every penny out of it.
So the foundation is solid. You got this successful integration fueling huge revenue growth, and they're maximizing their internal financial leverage. So now the question is, what's next? How do they turn that scale and cash into a real competitive advantage?
Well, they aren't just celebrating the acquisition. They are leaning hard into future tech, especially AI.
But first, on the integration, what's the strategic goal there?
It's about total market coverage. By putting Paycor and Paychex together, they now have two top-tier platforms that were critically built for different-sized businesses.
So they can serve everyone from a small shop to a mid-sized company.
The full spectrum. It's about building a wall against competitors. And they're ahead of schedule. They're on track to hit their revenue synergy targets, and they think they're going to exceed the cost synergies.
That's great for the bottom line, but for the user, I think the AI rollout is where the rubber really hits the road. And they're not talking about small features, are they?
Not at all. They're going after the big, transactional, historically human-intensive tasks. Let's start with the big one, agentic AI payroll automation.
Okay, you have to break down agentic for us. What does that mean here?
It's a huge step up from traditional automation. Agentic AI means the system doesn't just analyze data, it autonomously takes action to reach a goal.
So it's not just following a script.
No, they've deployed this to automate payroll for thousands of clients just based on voice and email. It understands unstructured input and then completes the task on its own.
And the accuracy rate they're reporting? It's nearly 100%.
That's a complete game changer. The immediate effect is that their human service teams are now shifting away from, transactional work like fixing data entry and moving toward high-value strategic advisory support.
So if the AI handles the mechanics of a pay run perfectly, the human's role has to change. You go from being an operator to a consultant.
That's a massive pivot in the required skill set. Your employees now need to be experts in compliance and tax codes, not just system navigators.
Which makes perfect sense when you look at their other AI launches.
Exactly. They know that as transactional work vanishes, the advisory role gets way more complex. That's why they launched the Generation AI Employment Law platform.
And what does that do?
It's built specifically to handle the regulatory nightmare. It helps HR experts and clients navigate constantly changing employment laws. It can generate compliant documents, and it keeps them updated on changes across different states.
So the AI does the legal grunt work, freeing up the human to actually apply that information strategically for a specific client.
Precisely. And they're turning this AI inward, too, for their own sales and service teams.
How does that work?
It's basically a unified agent that pulls data from all their internal systems. It gives their sales team, say, tailored scripts and answers on the fly. For service reps, it gives them deep historical context for every single client interaction. It's an intelligence layer.
And all of this, all this automation and support, it has to run on good data. They mention a patent pending system they call a knowledge mesh.
That's the engine room. That's what makes it all possible. A knowledge mesh is like a constantly updating internal Wikipedia, but built on every interaction they've ever had. Calls, emails, chats.
So it organizes all that unstructured data.
It organizes it into a connected, searchable network. That's what allows the agentic AI to act with such precision, and what allows the human advisor to consult with real expertise.
Okay, so if the strategy is all about this huge integration and tech transformation, we have to check the balance sheet. Can it support all this?
Oh, absolutely. Despite those high integration costs we talked about, they are on extremely stable financial footing.
What's their cash position like?
They're holding $1.6 billion in cash and investments. And critically, their cash generation is just phenomenal. Cash flow from operations for the first 6 months was $1.2 billion, which led to free cash flow of over $1 billion. That's way up from the prior year, and it shows the core business is just a cash machine.
And that cash is the fuel for the acquisition and the AI investment.
And it's being passed back to shareholders. They returned over $1 billion year to date, mostly in dividends, but also with some share repurchases.
So given all this, the integration is working, the AI is rolling out, the cash is flowing. What is management telling us with their updated outlook for the rest of fiscal 2026?
Their confidence comes through loud and clear. They raised their guidance for adjusted diluted EPS growth. They now expect it to be in the range of 10 to 11%.
Which is up from their old forecast of 8.5 to 10.5%.
Yeah, that's a really clear signal that they believe the Paycor integration and the AI efficiencies are paying off even faster than they originally planned.
And total revenue growth outlook is still really strong at 16.5 to 18.5%. It's also probably worth mentioning they're getting some external recognition for all this, right?
That's a good point. That external validation is important. They were named a Nelson Hall NEAT leader for 2025, specifically for their HCM technology and Gen AI.
So the industry is noticing.
The industry is noticing. And on top of that, they were named one of the world's most ethical companies for the 17th time, which shows that all this rapid change isn't coming at the expense of their corporate culture.
So let's wrap this deep dive up. Let's distill it down to the three core insights you should really take away from this. First, a major strategic acquisition is paying off. The Paycor deal is driving huge revenue growth, especially by bringing in those higher value upmarket clients.
Second, their commitment to AI is completely transforming their service model. They're using agentic AI to handle transactional payroll with nearly perfect accuracy, which is forcing a massive pivot in their human jobs toward high-value strategic advice.
And third, the financials are just rock solid. Even after absorbing $77 million in integration costs, their cash flow is incredible, they're rewarding shareholders, and management just signaled their confidence by raising the full-year earnings outlook.
And this leaves a really powerful final question for you to think about because Paychex is showing us a clear roadmap for the future. They're using AI to handle two things: the transactional grind and the ever-increasing regulatory complexity, like employment law. This suggests the real value of these services isn't about efficiency anymore. It's about using AI to manage complexity, which makes that remaining human expert advice incredibly valuable.
So the final thought is this.
Where in your industry will you see nearly 100% automation accuracy next? And what specific regulatory or strategic expertise will suddenly become the new essential role for the human advisors left behind?